Good evening, Trade Flare family. Welcome to the Nightly Breakdown, where we break down what happened today in the stock market, as well as give you an idea of what we're looking at into tomorrow. Now, before we head over to conduct a technical analysis of the SPY and 5 stocks, let's look at some key points to get a broader view of where we stand. So first, let's talk about the elephant in the room, which is Jerome Powell. So we have the Federal Open Markets Committee meeting tomorrow, in which afterwards we will hear from Jerome Powell. As of right now, Jerome Powell has not budged, but as of right now, there are a lot of different moving parts here that he must make sure that he acknowledges to make sure that they keep from falling apart. But overall, having all this clutter and volatility looks like a great opportunity for sellers to pounce on the market headed into a historically volatile and down month of August. But before we get ahead of ourselves, let's talk about what to expect from the FOMC. With what we've seen in the news recently with the inflation data and with all of the bond movement, investors are expecting Jerome to lean hawkish during the meeting tomorrow, and investors will not like it if there is a disagreement, because a lot of investors and a lot of Fed members actually are seeing that we should be tapering right now. So another thing to think about is that we have seen our peak economic growth, and our growth is expected to decelerate significantly from here until 2022. Firms like Goldman Sachs are already reducing GDP forecasts for this year and much more for next year. Something to keep in mind is that Jerome has been firm about the Fed's policy depending on the path of the pandemic, and we have rising COVID cases recently, so I expect that to be something that is mentioned quite a bit. If the virus causes Powell to take a dovish stance, then the market would probably hate that. We would see people pour into bonds, the banks and tech would start to sell off. It would get pretty ugly from there. But overall, whatever happens tomorrow, I'm expecting volatility, and I'm expecting Powell to be a little bit hawkish, leaning towards rolling out a taper plan towards the end of the year. So the next thing I want to talk about is China, and China is what caused today's volatility. It was not the FOMC tomorrow, it was China. So China, noticed that the Shanghai Composite had a historic down day today, and this is from continued sell-off due to added risk factors for investors from the Chinese Communist Party looming over all of Chinese companies. And this has always kind of been a risk, but it hasn't really made itself clear until recently. And this has added a ton of risk to these Chinese stocks, as they are basically limiting the structure for any companies considering a public offering. So this looks kind of like China is using this as a prompt to get Chinese companies to delist in the US and get secondary listings in Hong Kong and Shanghai. And this is all happening after cutting the RRR rate in the past few weeks. It feels like just a few weeks ago, every analyst was signaling to emerging markets, signaling to China. Now China making these moves, causing, a lot of fear, a lot of panic. This is something that, is telling me there might be something bigger going on in China. A lot of money pouring into US bonds right now. This is definitely something we want to keep our eye on heading into the next couple weeks. Overall, though, not overly bearish yet with the news. We had great earnings after hours from big tech and Visa, so we could potentially see a little bit of push and pull from that in the morning as we head into the FOMC later on in the morning. So next, let's head over to our last key point, which is, as always, our indices and our sectors. And all indices closed down today. The IWM led the way to the downside, Nasdaq was right behind, and then we had the SPY and Dow matched up, barely down around 0.3%. As far as our sectors went, the utilities sector led the way. Right behind was real estate, healthcare, and consumer staples. On the downside, we had communications, consumer discretionary, and tech. So notice the shift to the sectors that tend to outperform during a slowing economy. So that utility sector, that healthcare sector, and that consumer staples sector, as well as that TLT, that rush into bonds, all pointing to that flight to safety. With that VIX being high, this is just something to keep in mind as we head into the rest of the week with the FOMC earnings and all that stuff. So now let's head over to conduct a technical analysis of the SPY ETF, which tracks the S&P 500 index. So looking at the daily here, we've got a hammer candle right off of the top or the bottom of a gap. We did have good big tech earnings, and we did close up in the upper third of this range. So as far as tomorrow morning goes, I wouldn't be surprised to see a little bit more buying headed up to around 441.17 before the FOMC starts to bring some more volatility. In that case, we're looking to the downside. We're looking at that 435.60 level. On the break of that level, look for the quick snappy fill to 434.76, which is the top of that range. If we do fill into the range, look for the target at the bottom of the range at 430. As far as tomorrow goes, I think the line in the sand is 430. I don't think we'll go much lower than 430. If we do, it'll be pretty quick down to 425.55, where we should get some support from that 50-day moving average again. So as it stands, we're reacting, keeping our levels in mind, and keeping the idea that, you know, we are shifting into more of a risk-off environment right now. So we'll see if that has any effect on the overall market. So now let's dive into the watch list, starting off with Dominion Energy, ticker symbol D, and this is a utility sector play, so a pretty defensive stock, pretty defensive industry, pretty defensive sector. And as you can see here, trying to break out again like we did a few weeks ago. We had a 2.5% move, breaking through and holding above our 200-day moving average. And this is taking out a resistance trend line as well, and we probably could head up to 78.50 right now, especially if yields keep pointing towards an economic slowdown. Then we could see these industries start to take off. This is one of the bigger cap companies in the utility sector, so this one will have a lot of pull on the XLU. So definitely keeping my eye on Dominion Energy heading into the rest of the week and the rest of the month. Next up is a bearish trade idea, and this is on Skyworks SWKS. And this is just a clean reverse head and shoulders, actually two of them on the big chart. And if you zoom in here, so as it stands, looking to take out this neckline here around $184. On that break, we're looking to take a trade down to at least 178.40. If we get that break of that 50-day moving average, then we could probably trade down to our 200-day moving average, or somewhere around this support trend line or support level around 167.32. So definitely keeping my eye on the bearish trade for Skyworks here as this tech sector and these semiconductors start to fade out. This one does have earnings later on in the week, so that one could be a game changer. Keep that in mind as you're trading Skyworks. So next up on the watch list is Johnson & Johnson. These healthcare stocks, these pharmaceutical stocks, they tend to be pretty defensive, so I'm looking to see if they start to break out here. As you can see, we're breaking the top, the resistance trend line here of this. Honestly, it looks like an ascending triangle if it wasn't a lower low here, but overall looking like we're breaking out here. If we take out this 172.78, it looks like we could go higher, probably all the way up to 175 right away. But like we like to say, balance creates excess, and as you can see here, a lot of balance in the past 6 months, and we could start to see that excess play out to the upside. At this point, the 180 calls, the 185 calls don't look bad, especially if you're going with a lot of time. But as it looks like it's breakout time for Johnson & Johnson, so keep that in mind as you head into the rest of the week and the rest of the month. Next up on the watch list is Cigna, ticker symbol CI, and as you can see here on the daily, beautiful dip buy off of the 200-day moving average, tons of volume. As far as analysts go, the analysts give this one a median forecast of $300 and a low of $270. So this one is at a bargain right now. Price to earnings and a lot of valuations are giving this one the benefit of the doubt right now. The PE ratio is 9, the PEG is less than 1. Obviously, we see a lot of volume today trading off of this 200-day moving average. Long-term dip buyers are buying this thing up, and I'm interested to see if this dip has dipped, and it looks like it is pretty, because that's a nice hammer candle supported by solid volume off of that 200-day moving average with a solid healthcare sector. And if you draw this pattern, this is a falling wedge, which is a reversal pattern, so we're looking to take the break above this resistance trend line. So definitely keep your eye on Cigna as we head into the rest of the week. Next up on the watch list is Gilead Sciences, and this one is building up some pressure underneath this 69.50 level. So we got an ascending triangle, pressure cooker top, whatever you want to call it. Basically, sellers are running out of energy here, and this one's building up some pressure to go higher. So we're looking to take that break of that 69.50 level. And with the healthcare sector as hot as it has been, seeing this pattern is very attractive as a swing trader. Looking at those $75 calls for September. So definitely keep Gilead Sciences on your watch list as we head into the rest of the week. And that wraps up tonight's nightly breakdown. If you gained value, make sure you hit the like button, and don't forget to subscribe so you don't miss out on any live or educational content. If you're looking to be a part of our premier trading community, Check out the link in the description to join our Discord, upgrade to TradeFlare Pro, and get half off your first month using the promo code TFPro2021. Now, don't be mistaken, we are not financial advisors, and nor do we claim to be. The stock market is risky, you could lose money, so use all the information inside of these videos at your sole discretion. As always, you cannot forget that time is your most valuable asset, so quit wasting it. Get up, get out, and go get it, my friend.